Markets had a turn today for the better, with the S&P 500 up 6%. In terms of sectors, the best performing sector was surprisingly utilities, up over 13%. In second, consumer staples had a strong day with over an 8% gain. In terms of the loser, energy sector didn't do too well, slightly up, but only up about 70 basis points. The Dow Jones was also up on the day, up 5.2%, making it a week loss of 15.11%. The Nasdaq was up 6.23%, making it a week loss of 12.1%. In Canadian markets, stocks weren't up as much, but they still had a gain, with the S&P/TSX Composite Index up 2.63%. In terms of sectors, looking at the S&P/TSX capped indexes, the winner on the day was actually the materials with over a 9% gain. Also, the telecommunication services was up 6% and utilities was up 5.5%. The losers on the day was energy, which actually had a really bad day, falling about 9%, as well as consumer discretionary didn't do too well, falling 3.5%. In Europe markets, the FTSE was up 2.8%, and in Asia, the Nikkei was relatively flat, only up 6 basis points. Oil continues to fall sharply, with WTI falling 6.4% to around that $27 mark. Brent crude fell 5% to that 28.50 mark. Overall, Goldman Sachs now expects oil might fall down to $20 a barrel as the price war between Saudi Arabia and Russia continues to accelerate, as well as issues with demand as less people are traveling and airports aren't as full. Many airplanes are being canceled. Gold was also up 2.85% on the day, but over that 5-day mark, it's still doing kind of rough, down over 6%. There's some pretty interesting stuff going on in the treasury markets. Looking at the US and Canada treasury yields, the short term between 3-month and 12-month didn't really change over the day, but looking more at that long end, we saw a pretty big spike as the Canada 10-year is now at 91 basis points and the US 10-year is at 1.02%. The US 10-year went up about 30 basis points on the day, which is pretty significant increase. But just looking at those yield curves, they look significantly better than they did over the past year. In the currency markets, the US dollar and the Chinese yen are both performing strongly, up about 1% on the day. The Australian dollar continues to have weakness, as well as the Japanese yen took a turn from doing well and is slightly down on the day, as well as the euro. US retail sales fell 0.5% in February, which is a pretty significant drop. January's was actually a 0.6% gain. Overall, it was driven lower by the auto sector, which fell 0.9%, as well as from gas stations, falling 2.8%, but that is in line with the fall in gas prices overall. This isn't a really good look for the US economy going forward. As this is in February, it won't be hit by the brunt force of stores closing and everything being shut down from the virus, as we'll see more of those numbers coming from March. As I expect, that'll probably be a significant drop compared to this, as many stores have announced that they're closing down. The next store that has announced is Nordstrom, which plans to close all their stores down overall. A lot of economists and banks are coming out with new forecasts on what's going to go on with the global economy, with Morgan Stanley actually declaring that they expect the world economy to go into recession. In their base case, they actually expect GDP growth to fall by 0.9% this year around the world, which is a pretty sharp drop. For example, it only contracted 0.8% in 2009. Other places like Goldman Sachs don't have quite as low forecast, but are still predicting weakening growth of around 1.25%. S&P Global also expects that the range will be between 1% and 1.5%. Overall, it's really hard to say what's going on. I expect that these forecasts are based off of a decent amount of assumptions that would be probably hard to really know how accurate they are. And overall, it's hard to say how much the economy will drop going forward. With concerns over the next recession, governments continue to pump money into the economy through stimulus packages as well as lower rates. US has announced that they might be introducing an economic stimulus plan of 850 billion or more, but it has to be decided by Congress. So it hasn't been confirmed yet, but that's the proposal that's there right now. It says here that the new proposal is expected to include 400 billion in steps taken by the executive branch, including delay of tax deadlines and relief for student loan interest payments. It seems like a lot of the money is going trying to be put into deductions, so people basically get more money in their pockets. Some have suggested that actually give out $1,000 to each citizen, um, which is an interesting idea, considering that they're just planning on getting all this money out there, as well as they plan on giving more loans to small businesses that might not be able to survive with the loss of revenue, as many of them still have many costs that they have to maintain. I'm a little skeptical that this will have much improvements on the economic conditions. It's more to try and support the economy and signaling that things could be get better and that they're taking action. Because I don't really understand how necessarily small businesses increasing their debt levels to survive now, they're still going to have to pay back that loan in the future. Sure, it might not be significantly high interest with lowering rates, but they're still going to have to try and pay off all that money going forward. And it could have detrimental effects to the business if they're now got a higher debt to debt ratio and could impact certain of their other loans as well. Spain has also announced a huge stimulus package as they want to allocate as much as 219 billion in virus aid. Overall, they want to use 100 billion euros to guarantee for company loans. Also, another 17 billion euros as direct aid to companies that really need it to stay afloat, as well as they want to invest 83 billion in private investments, but not really much details on that. Overall, it seems like many countries are stepping up their stimulus packages. What's actually pretty crazy about this, as you can see here, it's 20% of its GDP, which is a huge amount when you consider that this is going to be funded primarily through debt. So overall, if this doesn't help things out much and yields continue to rise, especially as a lot of European debt yields have been on the rise as concerns over businesses actually being able to pay their interest and their loans back, this might not turn out the best for Spain. And they could, I don't want to say they will, but there could be a potential maybe down in the future that they have some situation that Greece used to have a couple years ago. France has actually announced that if necessary, they might nationalize companies that might not be able to survive. So some of their biggest companies that might be hit significantly by the economic situation going on, they might end up nationalizing them if they have to. This comes after they just recently guaranteed 300 billion euros of bank loans. This seems a little intense to plan to maybe nationalize things, as often nationalization doesn't end up going very well. As you can see, like places like Venezuela, as there are often issues with companies under the government. But I guess we'll have to wait and see. In Canada, manufacturing sales fell 0.2% in January. This is the fifth consecutive month that they have fallen, which isn't a good look. But on the upside, economists did expect a 0.5% drop for January, so they did a little better than expected. Overall, it was led lower by transportation equipment, petroleum, and coal products. A lot of that is kind of expected in the energy industry, has been struggling in the past. In volume terms, manufacturing fell 0.4%. Canada housing numbers came out for February as well, with a 5.9% month-over-month resale gain happening in February. There's also a tight supply east of Manitoba, where they're calling that it's a seller's market. In total, there was 7.3% new listings. MLS's home price index year over year rate was 5.9%, which is up from the 4.6% in January. Although these are pretty strong numbers for the Canadian housing market, the virus is going to have an impact, as many expect that people aren't going to be looking for houses right now. Even with those low interest rates, especially right now with Canada lowering their interest rates 1%, it's really not going to be a lot of people are going to look to sell because they really don't know what's going on right now, as some people may be out of job and can't really say what impact the economy is going to have. But overall, they expect prices will continue to hold and not fall even with this decrease in demand. With a lot of focus being on the stock market and how it's been falling, I thought this article was pretty interesting as it takes a look more at the debt side and how things have been going there, as there has been an issue with commercial paper. So that's basically 30 days debt. Often it's renewed at the 30-day mark, but companies are moving away from it as 10 US investment grade issues happened today, with big places like Pepsi as well as ExxonMobil planning to refinance with bond offerings instead of commercial paper. So Pepsi is planning to price a $6.5 billion offer, and ExxonMobil is looking to do a Ford with a five-part bond sale. The Federal Reserve has announced that they are planning on reintroducing the commercial paper funding facility, which was introduced in 2008 to help with the credit markets then. So basically, they're introducing a $10 billion of credit protection from exchange stabilization funds. This is planned on improving the commercial paper markets, as a lot of commercial paper has seen increases in yields a lot faster than the 10-year yields, which you often don't see, but in situations of economic distress, that's kind of what happens, as the short term is seen as a lot riskier because they're not sure how companies will be able to pay for their interests, their costs, as many companies are shutting down. You got stores like Apple closing down. They'll still have their online sales, but for stores that really don't focus on online sales, they could be hit pretty hard. It was also interesting how it pointed out that Europe is also having an issue, as they've seen their high grade company bond yields quadruple in the past 3 weeks. As it says here, it now stands at 1.26%, which is the most since January 2019. I mean, that's not too high when you consider January 2019 is only a year ago, but quadrupling in 3 weeks is pretty significant, especially when you consider how yields have been tending to fall over the past year. Most headlines have been dominated by economic news, government news, and central bank news. But in company news, there was a little bit going on in Europe as Volkswagen and Airbus have decided to shut down their plants in Europe. So Volkswagen is planning on shutting down their manufacturing plant for the next 2 weeks, as they expect output will be significantly lower, as they don't really know how many people are going to be buying vehicles in this situation. This is in line with a lot of places expecting a lot less coming out of the auto industry, as RBC forecasts a negative 16% growth rate in auto production in 2020. So many plants are also smaller places like Magna are also stopping production. It's hard to know when they'll fully get back online. While it says 2 weeks, I imagine that it might get extended.